The Federal Reserve is expected to continue cutting rates in 2026, but that doesn't mean that all rates will necessarily fall. So what does this mean for bond investors? Well, we think long-term Treasury yields and long-term bond yields in general might stay elevated, mainly due to sticky inflation and budget concerns. Because the Fed funds rate really only influences short-term interest rates, and other bond yields, specifically long-term bond yields, are more based on long-term growth and inflation expectations. With inflation still near 3%, investors might demand higher yields to compensate for the risk that inflation doesn't fall back towards the Fed's 2% target. And budget concerns could weigh on the market as well. Budget deficits need to be financed with more and more Treasury issuance. And we're not just worried about an increase in Treasury issuance, we're worried about an increase in corporate and municipal bond issuance as well. And when you get a lot of supply coming to the market, if it's not matched by an increase in demand, yields might need to stay elevated to attract that marginal buyer. So with that sort of outlook, we think long-term Treasury yields like the 10-year Treasury might stay elevated. The 10-year Treasury yield should stay near 4% or so. Unless the economy slows sharply, it might not fall much lower than 3.75%. And if we get some bounce of increasing inflation or rising inflation expectations, it could rise up to the 4.5% area.
And this likely means that we're going to see a steeper yields curve in 2026, where short-term yields move lower, but longer-term yields remain elevated. And that can present opportunities on the longer end of the yield curve. For most investors, we do suggest a benchmark duration. We think that can make sense. And a good starting point for the average investor is about 6 years. Now, we believe that there are opportunities in high-quality intermediate term bonds. For investors who are in higher tax brackets, in taxable accounts, municipal bonds may be worth consideration because they offer attractive tax-adjusted yields, and credit quality is generally fairly high. For investors who might be in lower tax brackets or investing in a tax-sheltered account like an IRA, we think investment-grade corporate bonds are worth consideration because they offer yields that are just shy of 5% on average, and credit quality in that market has been improving over the past few years.